November 28, 1940, New York City. His handwriting is careful, deliberate. The hand of a man who has made decisions worth hundreds of millions of dollars and who is now very calmly making one final decision. He leaves 8 pages behind. The last lines read, "My life has been a failure." That note is the most misread document in the history of financial markets, because the man who wrote it had at different points in his life been worth the equivalent of over $1 billion in today's money. He had moved markets single-handedly. He had been personally asked by JP Morgan to stop trading because his positions were making a national financial crisis worse. He had walked into rooms where powerful men went quiet. So how does a man like that end up alone in a hotel cloakroom, convinced that everything he built amounted to nothing? The answer is not found in his trading records. It's not found in the market cycles he rode or the crashes he called. The answer is found somewhere much harder to look, inside his own mind. Jesse Livermore did not lose to the market. He lost to himself. And the terrifying truth, the reason this story matters today, in an era of retail trading apps and 24-hour financial news, is that the psychological forces that destroyed him are the same ones operating in your portfolio right now. This is not a story about a man who failed. This is a story about a man who understood everything and still couldn't save himself. 1877, Shrewsbury, Massachusetts. Jesse Livermore is born into a farming family that has nothing much, no money, no connections, no particular ambitions beyond getting the harvest in before the first freeze. His father is a practical man, quiet. He doesn't believe in ideas that can't be turned into something you can hold in your hands. He expects Jesse to work the land. End of conversation. But from the time Jesse can hold a pencil, something is clearly wrong with this plan. Not wrong in a troubling way. Wrong in the way that a hawk raised in a chicken coop is wrong. The boy does not belong here. He belongs somewhere faster. Numbers speak to him. Not the way they speak to most children. Not as something to memorize and recite, but as a living language with rhythm and texture and hidden meaning. While other children play in the fields outside, Jesse sits at the kitchen table and finds patterns in things no one else is looking at. The number of fence posts between 2 farms, the intervals between thunderclaps, the price of corn posted in the general store. This is the first psychological marker we need to identify in Jesse Livermore. Psychologists call it pattern recognition, the cognitive ability to detect structure within noise. In most fields, this skill is a powerful asset. In financial markets, it is a double-edged blade of extraordinary sharpness. Because the market is not a simple system, it is a complex adaptive system. Millions of human beings all acting on incomplete information, emotion, fear, and greed simultaneously. There are real patterns in it, but there is also massive amounts of randomness, and the human brain, which evolved to find patterns in everything, in cloud formations, in animal tracks, in the behavior of enemies, cannot easily distinguish between a genuine signal and a coincidence that merely looks like one. Jesse Livermore had one of the finest pattern recognition minds of his generation, and that gift, that extraordinary, almost preternatural gift, would eventually become the mechanism of his ruin. At 14, his father makes it official. Jesse is done with school. He will work the farm. That is the plan, and there is nothing more to discuss. The night before his first full day behind a plow, Jesse Livermore leaves home. He takes $1 and the clothes on his back and walks to Boston alone. He is 14 years old. He has never been to a city. He has no contacts, no plan, and no fallback. What he has is an absolute bedrock certainty that numbers will take care of him if he can just find the right room. Jesse finds work at Payne Weber as a quotation boy, a chalkboard kid whose entire job is to stand at the board, listen to the ticker, and write the prices down. It pays a few dollars a week. It puts him exactly where he needs to be. Every single day for hours, Jesse Livermore stands in front of a river of numbers and watches them flow. And while every other boy in that room sees prices, abstractions, symbols, Jesse sees something else. He sees behavior. He notices that certain stocks move in predictable ways before a big run, that certain price levels act like walls, that the tape, the continuous stream of transaction data scrolling off the ticker, has a personality, a mood. He starts keeping a private notebook, not to trade, not yet, just to test his observations, to see if what he thinks he sees is real. This is a critical detail that separates Livermore from most speculators. Before he ever bets $1, he builds a model. He treats the market like a scientific subject and himself like a researcher. At 15, he makes his first trade, not on the New York Stock Exchange. Jesse has no access to that, but at a bucket shop. Bucket shops were the early 20th century's version of unregulated speculation dens, storefronts where ordinary people could bet on stock price movements without actually buying shares. You put money down. The price moves in your favor, you collect. It moves against you, you lose. No delivery, no settlement. Pure speculation against the house. Jesse puts $5 on Burlington Railroad. He wins. The profit is enough to feed a farm family for several weeks. He is 15 years old, and for the first time in his life, the world has confirmed something about him, that his mind sees things others don't, that his edge is real. Now stop here, because this is the moment everything begins, not the profit, the feeling. The feeling of being right about a market, of having your internal model validated by cold, indifferent reality, is one of the most powerful psychological experiences a human being can have. It is more potent than most other pleasures, because it is not just pleasure, it is proof. Proof that you are perceptive in a way others are not, that your mind works at a different level, that you are special. For a 14-year-old runaway from a poor farm family who has spent his whole short life feeling like he doesn't fit anywhere, that proof means everything. It doesn't just feel good, it feels like identity, and this is where the danger begins. Over the next few years, Jesse Livermore becomes a legend in the Boston bucket shops. He wins so consistently, so reliably, that shop owners start refusing his bets. They post his photograph at the door. He becomes the boy plunger, a nickname that follows him for the rest of his life. And every win cements the same belief deeper into the bedrock of his psyche. I am the market. The market is me. My judgment is my identity. This is the founding error. The crack in the foundation that every subsequent story of Jesse Livermore, every comeback, every collapse, every bankruptcy and resurrection, runs straight down into. When Jesse Livermore finally arrives in New York and starts trading on real exchanges, he loses almost immediately. Not because his reads are wrong. His reads are fine. He loses because the system is different. In a bucket shop, you bet on a price and the outcome is clean. On a live exchange, by the time your order reaches the floor, the price has moved. The spread has widened. What he thought he was buying at $42 costs him $42.50. Over hundreds of trades, that gap, what traders call slippage, guts his edge entirely. For the first time in his life, Jesse Livermore is confronted with a form of failure that has nothing to do with being wrong. His analysis is correct. His model is sound, but the environment won't cooperate. The world he's actually operating in doesn't match the world inside his head. In psychology, this experience has a name: cognitive dissonance. It's the acute discomfort that comes from holding two contradictory beliefs simultaneously. Jesse's core belief, I am someone who understands markets, is colliding with raw evidence to the contrary. And the way the mind handles this collision is almost never logical. We don't update our beliefs when they're threatened. We protect them. We rationalize, we reframe the evidence. We find explanations that let the belief survive intact. Jesse does not conclude, maybe my model is incomplete. He concludes, the environment is broken. The system is rigged. The game is different here, and once I adapt, I'll be fine. He is partially right, which is the most dangerous kind of wrong, because it means he never has to do the really hard work, the work of examining whether his fundamental assumptions about himself are correct. He goes back to bucket shops, accumulates more capital, returns to New York, loses again, goes back, returns. This cycle repeats, with variations in scale and setting, for years. Each time, Jesse gets better at adapting his mechanics. Each time, the underlying belief system goes completely unexamined. There's a concept in behavioral economics called the hot-cold empathy gap, documented extensively by economist George Lowenstein at Carnegie Mellon. The idea is simple. When we're in a calm, rational state, we can articulate exactly what we would do in a high-stakes emotional moment. But when we actually arrive in that moment, when the loss is real, when the fear is live, the emotional brain takes over. The prefrontal cortex, the seat of rational decision-making, gets outrun by the limbic system. Jesse Livermore, sitting in a library reading about markets, could tell you exactly what a disciplined trader does. Jesse Livermore, watching a position move against him in real time, was a different human being, and he never fully made peace with that split. April 1906. The San Francisco earthquake kills thousands and reduces one of America's great cities to rubble and ash. The nation is in shock. Markets are chaotic. Nobody knows what comes next. Jesse Livermore shorts Union Pacific Railroad. He has reasoned through the disaster with cold analytical precision. Insurance companies will hemorrhage cash to cover losses across the city. Credit will tighten across the entire financial system. Companies connected to California, regardless of whether their physical assets were damaged, will trade lower as money gets scarce and risk appetite evaporates. Union Pacific, a bellwether of Western commerce, will fall. He is right. The market drops. Livermore makes more money than he has ever seen in a matter of days. But his broker, a seasoned operator named Ed Hutton, orders him to close the position. "You've made enough," Hutton says. "Don't push it." Jesse covers his short. The market keeps falling as another 20% and without him on it. He follows the instruction. He takes his profit. And he walks away thinking correctly that he was right, and thinking incorrectly that he should have trusted himself more. That the lesson of San Francisco is, next time, let it ride. Trust your analysis all the way to the end. This is one of the most instructive moments in Livermore's entire career, not because of what he did, but because of what he learned from it, or rather, what he thought he learned from it. Behavioral finance researchers have documented a phenomenon called outcome bias, the tendency to judge the quality of a decision based on its outcome, rather than on the quality of the reasoning at the time the decision was made. Covering your position early and taking a profit is by any rational measure a reasonable decision. Calling it a mistake because the market kept going, that is outcome bias in its purest form. But Jesse didn't see it that way. He saw confirmation. He saw evidence that his instincts, left unrestrained, would have made him even richer. And that belief, that his unfiltered, undisciplined instinct was the truest version of his edge, planted a seed that would take years to fully bloom into catastrophe. The Panic of 1907 is America's first true 20th century financial crisis. Banks fail. Credit locks up. The stock market loses nearly 50% of its value in a matter of weeks. It is a moment of genuine systemic terror, the kind of event that erases fortunes, breaks men, and ends careers. Jesse Livermore has been building a massive short position for months. He has watched the credit expansion. He has watched margins get thin and leverage get thick. He has watched the optimism of the market become completely untethered from any underlying economic reality. And he has placed his bets accordingly, quietly, methodically, across multiple brokers so no single person knows the full scale of what he's doing. When the panic hits, his positions print money every single day. He sits at his desk and watches his net worth climb by tens of thousands of dollars per hour. The entire American financial system is in crisis, and he is on the right side of it. Then J.P. Morgan calls. Morgan, the most powerful private banker in American history, the man who is personally backstopping the entire U.S. financial system with his own credit, reaches out to Livermore directly. He tells him, "Your short position is making this worse. Every dollar you make is a dollar that accelerates the panic. Close it, for the good of the country." Jesse Livermore closes his short. He books approximately $3 million in profit. In 1907, money, the equivalent of well over $100 million today, the boy from the Massachusetts farm, the kid who left home with $1, is now a rich man. Genuinely, indisputably, extraordinarily rich. Pause here. Because this is the moment the psychological damage becomes permanent. Think carefully about what has just happened inside Jesse Livermore's mind. He has just made an enormous bet, against conventional wisdom, against the direction that 99% of market participants were positioned, and he was right. Not just a little right, catastrophically, magnificently right. The world validated his contrarian view in the most emphatic way imaginable, and J.P. Morgan himself had to pick up the phone and ask him to stop. What does that do to a person's sense of self? There is a specific psychological phenomenon called earned grandiosity, the cognitive state that emerges when someone achieves something genuinely extraordinary and begins to internalize not just the achievement, but a broader identity built on the assumption that their judgment is categorically superior to others. This is different from simple arrogance. Arrogance is a character flaw. Earned grandiosity is a logical trap. Your evidence is real. Your past performance actually supports your elevated self-assessment. And so the feedback loop becomes self-reinforcing and self-insulating at the same time. Jesse Livermore had earned his confidence. That's what made it so hard to correct. There is nothing like losing all you have in the world for teaching you what not to do. And when you know what not to do in order not to lose money, you begin to learn what to do in order to win. Jesse Livermore. Read that quote carefully. He's right as far as it goes, but notice what's missing. Any acknowledgement that winning big can be just as instructive a trap as losing. Every lesson Jesse Livermore articulates is a lesson learned from his failures. He never develops a framework for examining what his successes might be teaching him incorrectly. Between 1907 and 1915, Jesse Livermore goes broke not once but multiple times. He loses everything. He borrows money. He makes it back. He loses it again. Rinse, repeat. In 1908, he takes advice from a commodity operator named Thomas Hatch about cotton futures. This violates the first and most important rule Livermore has established for himself. Never trade on another person's tip. He knows this rule. He has articulated this rule. He breaks it anyway. And he loses almost everything he made in 1907. Why does an intelligent, disciplined man repeatedly break his own rules? This is not a rhetorical question. It has a specific psychological answer that applies to every single person who has ever sat in front of a trading screen and watched themselves do the exact thing they swore they would never do. The answer is that rules are cognitive constructions. They exist in the prefrontal cortex, in the rational, deliberate part of the mind. But trading decisions happen under emotional load, under stress, under excitement, under the peculiar urgency that markets generate. In those moments, the emotional brain, the amygdala, the limbic system, outcompetes the rational brain. Not because the rational brain is weak, because it is slower. Daniel Kahneman documented this in his Nobel Prize-winning research, later popularized in Thinking, Fast and Slow. System 1, intuitive, fast, emotional, makes decisions in milliseconds. System 2, deliberate, logical, rule-following, takes time. In markets where every second costs money, System 1 almost always fires first. And Jesse Livermore's System 1 had been trained for years to swing big, trust the gut, and go. The other factor in his boom-bust cycle is something behavioral psychologists call intermittent reinforcement, the same mechanism that makes slot machines more addictive than a steady paycheck. When rewards are unpredictable, when you can't know whether this trade will pay off or not, the anticipation itself becomes compulsive. Losing just means the next win is coming. You got it before. You'll get it again. Every time Jesse Livermore rebuilt from zero, the loop tightened. The comebacks became part of the legend, part of his story about himself. He wasn't a man who stayed down. He was a man who always came back. And that story, the narrative of the indestructible speculator, made it psychologically impossible for him to simply walk away. By 1915, he is effectively broke again. He scrapes together a small position in Anaconda Copper, trades it on borrowed margin, and claws his way back into solvency using nothing but tape-reading skill honed over 2 decades. It works. Again. From the outside, the comeback looks like resilience. From the inside, from what we now understand about the psychology of compulsive behavior, it is something more complicated. Each resurrection is also a reinforcement of the cycle itself, and a cycle that keeps paying off eventually and unpredictably is the hardest kind to break. By the late 1920s, Jesse Livermore has been watching the American stock market with growing alarm. The numbers don't add up. Stock prices are climbing at rates that have no connection to underlying corporate earnings. Margin debt, money borrowed to buy stocks, has ballooned to levels never seen before in American history. Ordinary people with no financial background are plunging their savings into the market, convinced that stocks only go up. The barber talks about stocks. The cab driver talks about stocks. Even the shoeshine boy, according to legend, is offering tips. And Jesse Livermore knows exactly what this means. He has seen this before. Not at this scale, but in its essential psychology. When everyone is positioned the same direction, when the consensus has become so universal that it feels like gravity, the correction doesn't just come, it comes with violence. He starts building his short position in the spring and summer of 1929. Carefully, quietly, using multiple brokers, multiple instruments, structured to avoid triggering alarm. The position grows to an enormous scale, and he waits. On October 24, 1929, the market breaks. Over the following days, decades of paper wealth evaporate. The Dow Jones Industrial Average loses a quarter of its value in 4 trading sessions. Banks fail. Brokerages collapse. Families who had bet everything on the prosperity of the Roaring Twenties find themselves with nothing. Jesse Livermore makes approximately $100 million. $100 million in 1929 money. While the country is in freefall, while families are losing homes and savings and any sense of security they had ever built. Jesse Livermore is the most profitable man in America. He returns home to his estate on Long Island. His wife, Dorothy, sees his face and assumes he has been ruined like everyone else. She begins preparing herself to offer comfort. He sits down across from her and says, "Dorothy, we have $100 million. She does not celebrate. She looks at him and says something that, by most accounts, cuts him more than he ever admitted. She says she is afraid, not afraid of losing the money, afraid of what it means to be the man who made it this way, afraid that the thing that makes him great is not something that belongs in a life she can share. She is not wrong. Here is the psychological reality of what has just happened to Jesse Livermore. He has ascended to a place where almost no one can follow him. His success is real, but it is built on a foundation that makes ordinary human connection feel impossible. He is celebrated by strangers and feared by people in power, but understood by no one, not even himself. Social psychologists use the term social altitude to describe the isolation that can accompany extreme achievement. It is not metaphorical isolation, it is functional isolation, the condition of inhabiting a psychological and financial reality so far from the norm that shared experience becomes nearly impossible. The people around you are either awed into silence or motivated by what they can get. Nobody just talks to you anymore. Nobody tells you the truth. Jesse Livermore, at the peak of his power, is completely alone. With $100 million and a name that fills newspaper front pages, Jesse Livermore should be, by any conventional measure, happy. He is not. He tries. He builds a remarkable private trading office with ticker tape machines running floor to ceiling, a staff of researchers, a yacht, a collection of cars. He hosts parties that draw the wealthiest people in America. He is seen at every important table in New York and Palm Beach. From the outside, it looks like a man at the height of his powers, enjoying everything he's earned. But the people close to him during this period tell a different story. Jesse is restless, distracted, present in body and absent in mind. He moves through the social rituals of a rich man's life, the way a soldier who has come home from war moves through civilian life, like someone who is fluent in a language that no longer applies to anything real. This is not a mystery. From a psychological standpoint, it is entirely predictable. Jesse Livermore had spent his entire adult life in a state of meaningful struggle, not just financial struggle, existential struggle. The need to prove himself, the need to survive, the need to demonstrate over and over that the boy who ran away from the farm had been right to run. That urgency was not just his motivation, it was his identity. It was the thing that made him feel real. Research in positive psychology, particularly the work of Martin Seligman and Mihaly Csikszentmihalyi on the concept of flow, consistently shows that human beings find their deepest sense of well-being not in comfort, but in challenge. In the state of being stretched to the edge of competence by a task that matters, remove the challenge and the well-being collapses, regardless of how many comforts replace it. Jesse Livermore had climbed the mountain, and on top of the mountain there was nothing to climb, only the long, slow, featureless descent. So he does what any addict does. When the thing that once gave them a high stops working at the old dosage, he goes back to it. Not because he needs the money. He has more money than he could spend in 10 lifetimes. He goes back because the market is the only place where he feels completely electrically alive. This is the most dangerous emotional state a speculator can occupy. When you are trading not to grow capital, but to feel something. When the trade is emotional regulation rather than financial calculation. Every protection discipline ever built gets quietly dismantled. Rules become inconveniences. Stop losses feel like self-betrayal. The thrill of the position matters more than the math of the position. And Jesse Livermore in the 1930s is increasingly trading to feel alive. Not to win, to feel. The 1930s break Jesse Livermore. Not all at once, slowly. In the way that water breaks stone, invisibly, incrementally, until one day the structure is gone and you can't point to the moment it happened. His tape-reading ability is still there. He can still see the market clearly in his analytical mind, but something has changed in how he responds to what he sees. The discipline that was once automatic, cut your losses quickly, let your profits run, never trade on emotion, begins to function erratically. Like a muscle that is still technically intact, but keeps misfiring under load. He holds losing positions too long. The logic is always the same, it will come back. I understand this trade. The market is wrong right now, but it will correct. What this sounds like is conviction. What it actually is, and what behavioral economists have documented extensively, is the sunk cost fallacy combined with loss aversion. Daniel Kahneman and Amos Tversky's prospect theory demonstrates that losses are psychologically twice as painful as equivalent gains are pleasurable. This means that for most people, regardless of intelligence, regardless of experience, the emotional pressure to avoid realizing a loss is significantly stronger than the rational calculation of what to do about it. Closing a losing trade at minus 20% is not just a financial decision. It is a psychological concession that activates the same neural pathways as physical pain. For Jesse Livermore, who had built his entire identity around being right about markets, closing a losing position was not just painful, it was identity-threatening. Admitting the trade was wrong meant admitting that he, the man who had called 1907 and 1929, had been wrong, and that was a cost his psyche could no longer afford to pay. So he holds, and watches positions that could have been closed at a manageable loss become catastrophic ones. There is a phenomenon that experienced traders describe, one that doesn't have a clean academic name, but that everyone who has spent serious time in markets has experienced. It's the moment when a loss gets so large that closing it becomes emotionally impossible. The position is so wrong, so deep underwater, that acknowledging it would require a level of self-confrontation the mind simply refuses to permit. So instead, you wait. You find reasons to believe in a reversal. You add to the position, the gambler's fallacy in its financial form, telling yourself that the lower the price goes, the better the value. Jesse Livermore does all of this. He, the man who had written with perfect clarity that you must cut losses and never ever let a bad trade become a catastrophic one, does exactly what he told others never to do. Because knowing the rule and following the rule are two entirely different neurological events. In 1934, Jesse Livermore files for bankruptcy. His debts exceed $2 million. His assets are negligible. The man who once held $100 million, the man who once made JP Morgan pick up the phone, cannot pay his bills. He is 57 years old. He has been rich and broken so many times that neither state feels entirely real anymore. What he has lost is not money. He has lost the one thing that anchored him to a sense of purpose. He has lost the story. Let's stop the narrative here, because this is the part of the story that matters most to anyone watching this video. not as history, but as a mirror. What were the specific psychological forces operating in Jesse Livermore? Not in the abstract, specifically mechanically, the way a doctor walks through what went wrong in a body, because these same forces are operating in every market participant alive today, including you, including me. Force 1. Identity fusion with performance. Livermore had fused his sense of self with his market performance so completely that there was no daylight between them. When the trade was winning, he was winning, not as a trader, but as a human being. When the trade was losing, the threat wasn't to his P&L, it was to his self-concept. This is one of the most destructive patterns in all of behavioral finance because it makes rational loss management essentially impossible. You cannot cut a loss that feels like cutting off a part of yourself. Research by psychologist Carol Dweck at Stanford on what she calls fixed versus growth mindsets maps directly to this. People with a fixed mindset, people who believe their abilities are innate, fixed traits rather than skills that can be developed, experience failure not as information, but as indictment. Jesse Livermore's entire self-construction was built on the idea that he was a special type of perceiver. Losses didn't teach him, they threatened him. Force 2, the narrative fallacy. Nassim Nicholas Taleb coined this term to describe the universal human tendency to impose clean causal stories on sequences of events that are partly or largely random. Jesse Livermore's career was not a predictable progression of skill rewarded by outcome. It was a complex interaction of genuine insight, market timing, leverage, and luck, with the proportions varying wildly from trade to trade. But the story Livermore told himself, and the story Wall Street told about him, had no room for luck. In the Livermore story, everything was analysis, everything was mastery. This narrative became a cage. When the market moved against him, the narrative couldn't account for it. Because in the narrative, the market doesn't move against Jesse Livermore without good reason. So rather than accepting that markets contain irreducible randomness that will sometimes punish even correct analysis, he would search for explanations that preserved the narrative. The trade wasn't wrong. The timing was off. Someone manipulated the tape. The system was different this time. Force 3. The echo chamber of wealth and fame. By the time Jesse Livermore was a well-known figure on Wall Street, the people around him were almost entirely people who either wanted his money, wanted his attention, or wanted to be associated with his legend. None of these people had any incentive to tell him uncomfortable truths. None of them were positioned to say, "Jesse, I think you're wrong about this one. I think you're holding because you can't bear to be wrong, not because the trade makes sense." The loneliness at the top of any high-status hierarchy is well documented. What's less discussed is the specific cognitive danger of that loneliness. When no one challenges your thinking stops being tested. And untested thinking, no matter how brilliant its source, drifts toward confirmation of whatever you already believe. Force 4. Meaning collapse. This is the deepest and most devastating force in Jesse Livermore's psychological story. Viktor Frankl, writing from his experience surviving the Nazi concentration camps, argued that human beings can endure almost any suffering as long as they have a reason, a why, that makes the suffering meaningful. Remove the why, and even comfortable existence becomes unbearable. Jesse Livermore's why was always the market, not the money, the game, the hunt, the daily encounter with a system that pushed back against him and demanded his full attention. When he could no longer compete at the level that made the game meaningful. When the talent was still there but the capital was gone and the body was aging and the world had moved on, his why disappeared, and he had spent 60 years building nothing else to replace it. No relationships that could hold him, no interests that could sustain him, no community that could absorb him, just the market and the echo of what it used to feel like to be inside it. In the final years of his life, Jesse Livermore writes a book. How to Trade in Stocks, published in 1940, is one of the most psychologically precise documents ever written about financial speculation. It is clear, honest, ruthlessly self-aware. It names every error he made. It maps every cognitive trap with the accuracy of someone who has fallen into every single one. And then he walks out of the room where he wrote it and proceeds to violate every insight the book contains. This is the final and most haunting paradox of Jesse Livermore's life. He was not unaware. He was hyper-aware, a man with almost clinical insight into his own psychological failures, who nevertheless could not change them. The knowing and the doing were permanently severed. This is not a character flaw, or rather, it is a character flaw that virtually all human beings share to some degree, and that the demands of financial markets expose with particular ruthlessness. Psychologist Jeffrey Pfeffer at Stanford has spent decades studying what he calls the knowing-doing gap, the chasm between what organizations and individuals know they should do and what they actually do when under pressure. His research consistently shows that knowing is almost never sufficient to produce doing. Behavioral change requires structural intervention, systems, accountability, environmental design. Knowledge alone almost never moves the needle. Jesse Livermore understood markets. He understood himself. He understood why he failed. He had no structure, no external accountability, no hard system, no person with the authority and the relationship to stop him that could bridge the gap between what he knew and what he did. His third marriage to Harriet is deeply troubled. His son, Jesse Jr., carries the weight of growing up in the shadow of a man who is simultaneously legendary and absent. The domestic reality of Livermore's life is a wreck, not because he is cruel, but because he is not actually present in any room that doesn't contain a ticker tape machine. There is a story from this period, told by people who were around him, that stays with me. In the months before the end, Livermore would sometimes sit in his private office for hours, not trading, not analyzing, just listening to the ticker tape run, watching the numbers print without making a single bet. He is not analyzing. He is not planning. He is doing what people do when the thing that once made them feel most alive becomes inaccessible. He is sitting as close to it as he can get, trying to absorb warmth from something that can no longer warm him. We come back to where we started, November 28, 1940. Jesse Livermore orders a drink at the bar of the Sherry Netherland Hotel. He sits alone for a while. Then he moves to a small table in the cloakroom and takes out a folded set of papers and begins to write. The note runs 8 pages. The handwriting is steady and clear, the hand of a man who is not panicking, not frantic, but resolved. He addresses it to his wife, Harriet. He goes through his life. He talks about failure. He talks about a kind of exhaustion that is not physical. Scholars who have studied the note carefully make an important observation. Livermore is not writing about money. He's writing about meaning. He is describing a man who has looked at himself clearly, perhaps more clearly than at any point in his life, and does not recognize in what he sees anything worth continuing. He writes, "My life has been a failure. Not my trades, not my account balance, my life." That distinction matters enormously, because it tells us that Jesse Livermore understood at the end that his tragedy was not financial. It was existential. He had constructed a life with a single pillar, the market, and when that pillar crumbled, there was nothing holding anything up. No other relationships, no other sources of meaning, no other version of himself he had ever taken the time to build. He was 63 years old. He had been famous for 40 years. He had been worth more money than most people can imagine, and he could not find a single reason, in 8 pages of careful, sober reflection, to keep going. Jesse Livermore has been gone for 84 years. The market has changed almost beyond recognition. Decimalization, algorithmic trading, passive index funds, options markets of staggering complexity, the rise of retail trading on apps built to feel like games. None of that has changed the psychology. The cognitive architecture that destroyed Jesse Livermore is identical to the cognitive architecture you sit down with every time you open your brokerage account. The names for the biases are newer. The mechanism is ancient. Lesson 1. Never let your identity and your trading results become the same thing. This is the foundational error, the crack in the wall that everything else runs through. When a trade being wrong means you are wrong, when a losing month means you are a loser, you have made rational risk management psychologically impossible. Because cutting a loss stops being a mechanical action and becomes an act of self-destruction. And human beings are extraordinarily resistant to acts of self-destruction. The practical application. Develop an identity built around process, not outcome. You are someone who makes well-reasoned decisions under uncertainty, not someone who is right about markets. Right and wrong will take care of themselves. Process is something you can actually control. Lesson 2. Competence in one domain does not transfer to immunity from psychological failure. Jesse Livermore was genuinely extraordinarily gifted at reading markets. That gift did not protect him from cognitive biases. It didn't inoculate him against loss aversion, sunk cost thinking, or the narrative fallacy. If anything, his extraordinary success made those biases harder to detect, because the evidence kept suggesting that his instincts were right, even when they were catastrophically wrong. Being good at investing does not make you less human. The research consistently shows that financial expertise does not reduce susceptibility to cognitive bias. It sometimes increases it, because experts are better at constructing convincing justifications for whatever they're already inclined to do. Lesson 3. Rules are not enough. You need systems. Jesse Livermore knew every rule in the book. He invented half of them, and he violated them repeatedly under emotional load in ways he could predict and describe in advance and still could not prevent. This is not a failure of willpower or intelligence. It is a fundamental feature of human cognition under stress. The implication for every trader and investor alive: rules you only execute when you feel like it are not rules. They are aspirations. The only rules that protect you are rules that are structurally enforced. Automated stop losses, position sizing that is calculated before you enter the trade and fixed before emotions engage. Accountability structures that don't bend to in-the-moment rationalization. Feelings are real and powerful. Your system needs to be stronger than your feelings, or your system doesn't exist. Lesson 4. You need at least one person who will tell you the truth. Jesse Livermore spent the peak years of his career surrounded by people who wanted access to his genius, his money, or his legend. Not one of them had the relationship, the authority, or the incentive to say, "Jesse, I think you're in denial about this position. I think you're trading to feel something rather than to make money. I think you need to stop." Every serious investor, professional or personal, needs what amounts to a designated truth teller, someone with no stake in flattering you, someone who has earned the right, through track record and trust, to deliver uncomfortable assessments. This is not weakness. Finding one person willing and able to do this for you is one of the most valuable things you can do for your financial future. Lesson 5. The market is a mirror, and the reflection it shows is accurate. Markets are not rigged against you. They are not personal. They are a vast impersonal aggregation of millions of human judgments, acting on incomplete information in real time. They do not punish you for being stupid or reward you for being smart. They simply reflect probabilities, and they are exquisitely sensitive to the psychological errors of their participants. Greed, fear, overconfidence, loss aversion, the sunk cost fallacy, confirmation bias, narrative fallacy, every cognitive weakness that human beings carry into the arena, the market finds. Not because markets are hostile, because markets are indifferent, and indifference at scale is the most honest feedback mechanism ever devised. Jesse Livermore spent 50 years staring into that mirror. He saw himself clearly, at least in retrospect. He described what he saw with extraordinary precision. What he could never do was change what looked back at him. That is the distance that destroyed him. Not the distance between his highs and his lows, the distance between who he knew he needed to be and who he was when it counted. Jesse Livermore was buried quietly. There was no grand ceremony, no procession of the great and powerful filing past to pay their respects, no eulogies read by senators or titans of finance. The man who had once forced J.P. Morgan to make a phone call was interred in the manner of an ordinary man who had lived an ordinary life and left without commotion. But his story did not go quiet with him. Jesse Livermore's story lives in every trader who has ever sat in front of a screen at 2 in the morning, watching a position go red, hands steady on the keyboard, telling themselves they'll just wait another hour before deciding. His story lives in every person who has ever felt the overwhelming difference between knowing what they should do and being capable of doing it. His story lives in every human being who has poured so much of themselves into a single pursuit that the thought of that pursuit failing becomes indistinguishable from the thought of themselves failing. Livermore was not undone by a bad trade. He was not undone by an unlucky market or a corrupt system or forces beyond his control. He was undone by the oldest and most relentless adversary any person ever faces. The version of himself that he had never examined, never questioned, never forced to justify its existence. The market didn't kill Jesse Livermore. The market just held up the mirror long enough that he had to see. The markets are never wrong. Opinions often are. Jesse Livermore. He wrote that. He believed it about the market. He never applied it to himself. And that, more than any single trade, any bankruptcy, any boom or bust, is the lesson of Jesse Livermore's life. Jesse Livermore, 1877 to 1940. The greatest speculator who ever lived. The man who read every market. The man who never once, not fully, not honestly, not in time, read himself. When we began researching this video, we were looking for a story about financial genius and financial ruin. What we found was something more unsettling than that. We found a story about the gap between intelligence and wisdom, about the difference between understanding a system and understanding yourself, about what happens when a person is extraordinary at one thing, one narrow, specific, punishing thing, and builds an entire human life on that single foundation without ever stopping to ask, what happens if the foundation moves? Jesse Livermore was not an unusual man in the ways we most often talk about. Yes, his talent was rare. Yes, his achievements were historic. But the psychological patterns that shaped his life, the identity fusion, the narrative protection, the inability to bridge knowing and doing, the collapse of meaning, these are not exceptional. They are universal. Every person who has ever sat with a losing position and felt the pull toward hoping rather than acting, that's Livermore. Every person who has ever broken their own clearly stated rule because the emotional pressure in the moment overwhelmed the principle formed in a calmer one, that's Livermore. Every person who has ever looked back at a decision and understood exactly what went wrong and remained unable to prevent the same thing from happening again, that is the most Livermore thing of all. The market in the end is not the story. Jesse Livermore spent 50 years believing that the market was the story, that the numbers, the tape, the positions, the profits and losses were the substance of his life. They weren't. They were the arena in which the real story played out, the story of a man trying to understand himself and running out of time. He never made it. But the attempt, recorded in his trades, his writings, his failures, and his final 8 pages, is one of the most human documents the financial world has ever produced. He deserves to be remembered, not as a legend, not as a cautionary tale, as a human being who carried the full weight of being human into one of the hardest arenas ever devised, and who, despite everything, never stopped trying to figure it out. Know yourself before the market decides for you.